Interest rates play a powerful and often underestimated role in moving the stock market because they influence how money flows through the entire economy, affecting consumers, businesses, investors, and valuations all at once. And understanding this relationship is essential for anyone serious about investing or financial decision-making. At the most basic level, interest rates represent the cost of borrowing money. And when central banks such as the Federal Reserve, the Bank of England, or the European Central Bank raise or lower rates, they are effectively tightening or loosening financial conditions across the economy. When interest rates are low, borrowing becomes cheaper, encouraging businesses to take loans to expand operations, invest in new projects, hire more employees, and innovate, while consumers are more likely to spend on homes, cars, and credit, which boosts corporate revenues and profits, creating a supportive environment for rising stock prices. This is why periods of low interest rates often coincide with strong stock market performance, as investors are willing to pay higher prices for shares due to better growth prospects and fewer attractive alternatives for their money. Conversely, when interest rates rise, borrowing becomes more expensive, which can slow down business expansion and consumer spending, reducing future earnings expectations and putting downward pressure on stock prices. Higher rates also directly affect how stocks are valued, because investors use interest rates as a benchmark when calculating the present value of future cash flows, meaning that when rates rise, future profits are discounted more heavily, making stocks appear less attractive even if the company itself has not changed. As legendary investor Benjamin Graham explained, the value of any investment is the present value of its future cash flows, and interest rates play a critical role in determining that present value. Another important mechanism is competition for capital, because when interest rates rise, safer assets such as bonds, fixed deposits, and savings accounts begin to offer higher returns, prompting investors to shift money away from stocks toward lower-risk options, especially during periods of uncertainty. This rotation out of equities can reduce demand for stocks and lead to market corrections or prolonged downturns. Interest rates also affect different sectors of the stock market in different ways, as growth-oriented companies, particularly in technology and innovation-driven industries, tend to be more sensitive to rate increases because much of their expected value lies in future earnings, while value stocks, dividend-paying companies, and financial institutions may perform relatively better in rising rate environments. Banks, for example, often benefit from higher interest rates because they can earn more on loans relative to deposits, whereas highly leveraged companies struggle as debt servicing costs rise. Investor psychology further amplifies the impact of interest rate changes, because markets are reacting not only to actual rate movements but also to expectations and central bank signals, which is why even rumors or guidance about future rate hikes or cuts can cause sharp market reactions. As Warren Buffett famously said, interest rates are to asset prices what gravity is to the apple, highlighting how profoundly they influence valuations across markets. Inflation is closely tied to this dynamic, as central banks often raise rates to control rising prices, and when inflation is high, companies face higher costs for raw materials, wages, and logistics, squeezing profit margins and increasing uncertainty for investors.